All right, let's get right into today's explainer because we're tackling something absolutely fascinating, the carbon credit life cycle. Now, it's super tempting to think of carbon credits as a natural resource, right? Like mining for gold or drilling for oil, but actually, scratch that. They aren't naturally occurring at all. They are entirely constructed financial assets. And to get from a theoretical concept to a tradable asset sitting in a portfolio, a carbon credit has to survive this rigorous, highly precarious life cycle. So we're going to map out exactly how that works, where the hidden pitfalls are, and where real value is created or destroyed. Okay, let's dive into this, because this is honestly the core question that makes carbon markets so wild. How exactly do you take an invisible gas, something you literally can't see, touch, or hold, and transform it into a regulated, priced, and tradable financial asset? Well, unlike traditional commodities that have intrinsic physical consumption value, carbon credits are completely dependent on policy, on methodologies, and above all else, on trust. To see how this transformation happens, we're going to walk through the 5 main phases of the carbon credit life cycle: designing the carbon asset, building the trust layer, issuance and market trading, retirement and future liabilities, and finally, value creation and destruction. But honestly, don't think of this as a simple, easy checklist. It's much more like a treacherous risk pipeline. All right, phase 1, designing the carbon asset. This is where the whole thing is conceptualized and essentially born. We kick things off with 3 steps: project origination, methodology selection, and baseline setting. Now, project origination is where a developer finds an activity that can reduce or remove emissions, like, say, planting a massive forest. But here's the thing. This is fundamentally an investment decision made under extreme uncertainty. The developer is basically placing a massive bet on whether the project will be financially viable, way before a single credit is ever issued. This isn't just theory, it's a high-stakes, real-world business gamble. And this equation brilliantly illustrates the cold financial reality developers are facing. You've got the expected project value here. It boils down to a developer weighing the expected future carbon price against the quantity of credits they hope to generate minus their costs, all discounted over time. So if they choose the wrong methodology back in step 2, their credit volume or regulatory eligibility could literally collapse overnight. That turns a fantastic environmental idea into a total financial disaster. Which brings us to step 3, the baseline. Now, this is absolutely the most economically sensitive and, frankly, controversial variable in the entire offset generation process. The baseline is your counterfactual scenario. It's basically a hypothetical story about what would have happened if this project didn't exist at all. Would that forest have been chopped down? Would that coal plant have been built? The credits generated are simply the difference between this hypothetical baseline and the project's actual real-world emissions. And here is exactly where environmental idealism slams into cold financial reality. If you overestimate the baseline, like, for example, assuming some massive rate of deforestation that honestly was never going to happen, well, you end up issuing way too many credits. This is overcrediting. It completely compromises the environmental integrity of the whole system, and you know what? If the market catches on, the value of those credits absolutely plummets. So, let's assume we've designed our asset and set those baselines. Now we move into phase 2, building the trust layer. This is the MRV phase, where we've got to clear 3 massive hurdles: validation, monitoring, and verification. First up is validation, which is a strict, upfront, ex-ante assessment by an independent third party. They make sure the project meets all methodology requirements before it even gets off the ground. Next is monitoring, and this is just the ongoing, everyday operational grind of collecting data on how the project is actually performing. And finally, verification, the definitive ex-post confirmation that the emissions reductions actually happened exactly the way they were reported. That verification step, it's absolutely crucial. It is literally the bridge that turns a tree growing in some remote forest into a verifiable digital financial asset. But there's a massive trade-off here. If you want higher verification rigor, using better tech and more frequent audits, that dramatically boosts market trust and the credit's integrity. But on the flip side, it heavily increases the upfront and ongoing costs for the project developer. All right, let's move to phase 3 and see how this builds into actual market mechanics, issuance, and market trading. So once a project is verified, the credits are officially issued into a registry, like Vera or the gold standard. This is a kind of magical moment in the life cycle, really. It is the exact moment an environmental outcome is converted into a liquid financial asset. The value is finally realized, and the developer can now hold, sell, or trade these units freely on the open market. And once they're issued, welcome to the secondary market. This is where buyers and sellers connect, And brokers step in to help figure out what these highly heterogeneous credits are actually worth. It's all about price discovery. But just like stocks or traditional commodities, a credit's price here isn't just about the carbon anymore. This open market introduces volatility, arbitrage opportunities, and plenty of speculative dynamics. Ultimately, the value is heavily dictated by market access, liquidity, and those rapidly shifting winds of policy outlooks. Eventually, a credit is bought by an end user who actually wants to use it. That brings us to phase 4, retirement and future liabilities. Now, when a company wants to claim they're carbon neutral, they have to officially retire the credits they've purchased in a registry. This action removes that specific credit supply from the market permanently. It can never be traded again. And this retirement is the fundamental basis for a corporation's public sustainability claims. But here is the surprising twist. The risks actually persist even post-retirement. Let's say a company bought credits from a forest protection project, retired them, and proudly announced to the world they are carbon neutral. Well, what happens if a massive wildfire sweeps through that exact forest 2 years later? That is a reversal. The stored carbon literally burns up into the atmosphere, and with it, the validity of the corporate claim goes right up in smoke. Plus, you face risks of retroactive baseline invalidation if investigators later find the original math was flawed, or even just because market standards evolve and suddenly decide your older credits are low quality. Because of these lingering post-retirement risks, a corporate buyer is incredibly exposed. Think about it. If a retired credit is later exposed as junk, or if the forest burns down, the public backlash and reputational damage to that corporate buyer can be far, far worse than whatever they initially paid for the credit. Buying a cheap, low-quality credit isn't a bargain, it's a massive strategic liability. Now, let's bring all of this together and look at the overarching equation of this entire life cycle in our final phase, value creation and destruction. So, the crucial point here is understanding exactly where worth is built and where it crumbles. Value is created early and rapidly through smart project design, rigorous, defensible baseline setting, and successfully navigating that tricky issuance process. On the flip side, value is destroyed by taking shortcuts, poor methodology selection, weak monitoring data, and ultimately credibility failures in the market. At the end of the day, the asset's worth is entirely dependent on its weakest link. As one expert in the source material perfectly puts it, the life cycle is not linear. It is a risk pipeline where each stage introduces potential value erosion or enhancement. And it's so true. From the very second a developer conceptualizes a project to years after a corporation retires the credit, risk is just constantly being managed, priced, and negotiated. Which leaves us with a massive, provocative question for the future of climate finance. Given everything we've just talked about, especially forests burning down or baselines being completely invalidated, should post-retirement liabilities be formally embedded into carbon markets? Should a company be forced to replace a burned credit 5 years down the line? It just goes to show how much this market is still evolving and just how carefully we have to value the invisible.